I'm Jeff Turnahoy, Head of America's Research at Lipper. I'm joined today by Geof Marshall, Vice President, Portfolio Management at CI Investments. Geof, welcome.
Thank you very much.
Geof, here's a question. What is it about your strategy that sets it apart from its peers?
The Signature High Income Fund is managed and constructed with a view of funding the distribution payment in the best risk-adjusted way possible. We try to accomplish this with what we view as the optimum risk-adjusted asset mix. That strategy applies not just to the asset mix decision, but also to a security selection. Well, we don't need to hit home runs with this fund. We need to avoid round-tripping our clients. That was the original strategy of the fund when it was launched in 1997, and the Signature team has stuck with that strategy in the last 15 years. What sets this fund apart? I think what sets this fund apart is that it's total return focused and it's benchmark agnostic. Because I think at the end of the day, through a market cycle, there are no relative return investors. Maybe only relative return managers dealing with redemptions. At the end of the day, no one wants relative returns.
Geof, do you consider the strategy behind the Signature High Income Fund to be top-down or bottom-up?
Well, I think the structure and the investment philosophy that Eric Bushell has built into the Signature model is a big reason for the consistency investment returns. The Signature model is one of global equity sector specialists, fixed income portfolio managers, and macro strategists, with the macroeconomic call spearheaded by Eric.
So what sort of advantage does that confer on your investors?
Well, we would take the view that our process is neither top-down nor bottom-up, but perhaps circular. The Signature model is cooperative. I think really every sector, security, and asset class call is a team effort. And I like to say I'm the only high-yield bond manager in Canada that has 30 people actively involved in my fund. How does this benefit our investors? I think as portfolio managers, we have a responsibility to listen to all parts of the markets and apply that as we can to our analyses and funds. Ultimately, this is a business of information, and the more brain power you can dedicate to a fund, the better. And secondly, I think most importantly is, I think this circular model, this cooperative model allows us to be more nimble than maybe other traditional managers with a more siloed approach. And I'm thinking we're less inclined to miss the forest for the trees than other siloed managers.
So Geof, is this strategy better suited to aggressive or conservative investors?
Well, Jeff, I think like any good portfolio manager, I'm going to hedge my bets and say both actually.
Okay.
In our experience, we find that investors and their advisors use the Signature High Income Fund in two ways. First, there is a group of aggressively minded investors that use the Signature High Income Fund as a more total return balance fund, where the higher rate of income is secondary to the diversification benefits from the non-traditional balance fund holdings. The fund holds high-yield bonds, which I am responsible for, as well as REITs and dividend-paying common stocks, which are overseen by Ryan Fitzgerald and Joe D'Angelo. There is another investor constituency, a more conservative investor constituency, that uses the fund for the higher rate of income that it provides than the traditional income investments like GICs or Government of Canada bonds. And I think the important point to make is that the sources of income are diversified, so the sources of risk are diversified. And then I'd point out that we've had great success with the Signature High Income Fund. Over the last 15 years, it's generated a 9.7% average annual return with less than half, actually 42% of the volatility of the TSX 300. So risk-adjusted returns have been very good.
In 2011, a lot of investors were caught off guard by the success of conservative strategies. Do you think that's a trend that'll continue in 2012?
2011 saw all-time low yields in Canada and US bond markets, with the yield on the Government of Canada 10-year bond touching 1.84% in December. Any balance fund or a conservative strategy that was long duration or overweight government bonds should have outperformed in 2011 as strong bond performance offset lackluster equity returns. The Signature High Income Fund was actually underweight government bonds and shorter in duration, but still posted a 4.8% return in 2011 for strong first quartile performance. And I think that's a testament to the security selection of the fund and risk management. do I think this can continue in 2012? For conservative strategies to perform, I think we would need government bond yields to rally further, which I think is unlikely at this point. That being said, the the asset classes that are held in this fund, high yield bonds, REITs, and dividend-paying common stock, what we're seeing is an underlying insatiable demand really for these asset classes, and this fund will stand to benefit. And so perhaps these asset classes and the fund does not outperform per se, but generates a comfortable high single-digit type return.
So do you expect more volatility in the year ahead?
That's really a good question, Jeff. 2012, we find ourselves in the midst of what I think to be a deleveraging cycle. And whether the global capital markets are deleveraging or leveraging, in my experience, it magnifies the effect of the business cycle. For some context, in the 1990s, with the last leveraging decade, in the 1990s, US GDP grew at 3.2% per year on average, and the S&P 500 did 19% per year on average, and by comparison, high yield bonds did 11.8%. In the 2000s, I think the 2000s were a transition decade where industrials and other corporates were not generally levering up their balance sheets, but the household sector, consumers, and banks generally were, ultimately, as we're finding out, to our detriment. In the 2000s, US GDP was 1.9% per year, and stocks managed a 1.2% average annual return. And again, by comparison, high yield bonds did 8.4%. So now we find ourselves in a deleveraging decade, and the forced selling that often accompanies deleveraging is inherently volatile. I think add to this austerity measures by governments globally, an uncertain policy framework in regards to Dodd-Frank and the Volcker rule and how that can affect market making, and more expensive bank capital vis-a-vis Basel III, which could ultimately restrict lending, then I think, yes, you are looking at an ongoing challenge of volatility in 2012. That being said, we seem to be back in the risk-on mode, or perhaps more likely a lull in the storm, as evidenced by the higher Canadian dollar, a better tone in the equity markets. Yields on Italian bonds have fallen about 1.5%. So I'm inclined to think that while volatility will continue to be a challenge, it will be lower, and the amplitude of the risk-on, risk-off trade seems to be moderating. I think even if volatility does moderate, we could see ongoing low participation in straight equity portfolios and increasing participation in income-type funds, conservative balance-type funds, like the Signature High Income Fund and its sister fund, the more globally oriented Signature Diversified Yield.
Last question, Geof. What parts of your portfolio appear poised for a breakout this year?
Well, I should qualify my comments with the forecast that the low interest rate, low economic growth environment in North America persists, and that the worst of the European sovereign debt crisis is behind us. High yield bonds have had a strong 3-year run, outperforming stocks over those 3 years and actually beating stocks in each of the last 3 years. I think high yield bonds can generate coupon-like or high single-digit type returns in 2012, and I think defaults can stay low. In terms of breaking out, though, we see REITs and dividend-paying common stock as particularly attractive. And I'm speaking here, though, of course, of companies that haven't already where the securities haven't already gotten ahead of themselves. We're finding that a lot of these opportunities are outside of Canada. The Signature High Income Fund actually has a broad mandate and actually typically holds a healthy non-Canadian weighting as part of trying to find the best risk-adjusted asset mix.